friends, this is CS Kirtna. Nasdaq has been hitting new low every day, and we all know just in 6 months it has wiped out nearly 7 trillion US dollar in market capitalization. There are two categories, there are two opinions presently prevailing. One category, they feel that this is actually going to be really worse and there might be a crash and they just wanted to sell. Second category, they are like, this is a buy on dip opportunity. This is a massive correction. If you want to take a side, then you should be listening to this video, because here I want to tell you why I feel technology is a new consumption. Second, how market capitalization of company and sector has changed in one decade, past 10 years. 3. A quick glance at fundamental analysis or how to study the revenue models of this tech company. 4. What is my approach and my suggestion? So stay tuned till the end, and if you like this video, please press subscribe button and share it with your friends. Let's quickly move on to our first point. Technology is a new consumption. Just imagine the way technology has become an integral part in our life. How much it has impacted. The way we communicate, socialize, productivity, commuting, efficiency, even, education, our remote working model and flexible working model, everything has been possible because of technology. It is deeply embedded in our life. Now I started feeling technology has become a consumption story. Just like we consume our daily commodities, like we eat bread, rice, or consume milk, now we are consuming technology also in the same way. It has become a consumption play. Why I am drawing this point is to link it to another investment point. A basic rule says that you should be having all-weather stock in your portfolio. Why? Because no matter what happens in the economy, whether it is up or down, there are certain set of stocks where the demand is always there. Demand will not totally collapse. It might reduce, but it will be there. Why? Because we can't live without consuming them. For example, clothes or retailers and consumer durables and the basic items like that we consume, rice or bread or milk, dairy items, anything that I'm saying. So these are essential commodities without which we can't live, right? These also become our all-weather stock. It's nice to have in portfolio because whenever there is a crisis time, it brings the volatility down and it infuses stability in your portfolio. Now, don't you think when I am saying you that technology has become a consumption play, that it's a time to accumulate or buy rather than selling it off? Because whenever a particular good or the commodity is becoming integral part of your life, you should look at the companies, those who are producing it. And if you try to get the share of those companies, it makes your fortune. Deal done. Second, here I want to emphasize how market capitalization by company and by sector has changed over 10 years. 2009. If you see the sector-wise composition, 36% has come from oil and gas, followed by financial services, and third, technology and consumer goods constituting 16%. Whereas, now if you see the sector-wise distribution, it is 56% entirely just by technology. Next, financial services and oil and gas is reduced to 7%. Just look at the way how drastically things have changed. Now take the companies. Top 5 companies in 2010. If you Google, you will find out ExxonMobil being the first. And our PetroChina was there. Definitely Apple and Microsoft was there. But remember, now if you see the composition, 99% is from technology sector. Means Google, Amazon, Facebook, they made a new entry. And they are the major players now. Now you may ask, always everybody says that past performance is not indicative of future, so I don't know whether the same story will repeat itself in future. If that is a doubt, You should be hearing this piece of data, where Goldman Sachs report says that in just 2025 alone, the new pillars of technology like cyber security, artificial intelligence, drones, blockchain, AR, VR will contribute 1210 billion worth of value creation in just 2025. I'm not even stretching it to 2030. So, do you see a huge opportunity and potential in technology sector now? Third point. The basic question before investing is, I always emphasize you have to understand the revenue model, the basic business model, the fundamental value drivers, because PE, price earning ratio, whatever you see now, it is just, the price that investor or the market is betting on or willing to pay looking at the revenue growth. Sometimes this kind of expectation also creates speculation or the bubbles, and in testing times like this, these bubbles are busted. So PE nowhere indicates what is the inherent intrinsic value of a company. In any time, in any given time, if you see, the fundamental value drivers, price always comes to that level. When the bubble is burst, price is at that level. So you should be able to analyze what is that value driver, what is that revenue growth model, what is the fundamental risk factors in any business model, how the growth happens, everything. Why this is important? When you are taking any, for example, retailer company, it's fairly simple, valuation. You take some metrics like the customer or the retail outlet or the turnover and assign a multiple, it's going to be okay. Whereas when you are talking about technology company, there are wide array of factors to be considered, like your IP, intellectual property, monopoly or the competitive position, and the revenue model, monetization model, user base, and how it is growing, everything, These are factors in general I am talking about. What I am essentially stressing upon is only one point. Technology companies, initially they need a lot of investment. The upfront investment is going to be really huge, because this is where they build the infrastructure, they get you the right product, they have to hire and retain a lot of best of best talent for doing that, right? So initially there is going to be a crazy investment. If any player sustains there, then upscaling opportunity, profit potential, margin is going to be huge in coming days. That sustaining part is very important. Then that takes us to the next point. How do I know which company will sustain and which will make good revenue and which will sustain in the game? Because tomorrow that company may not be there. 5 years down the line it may not be there. Yes, I agree here. There is an interesting study which is done by McKinsey, and where they say that it can be the growth model, revenue model can be categorized into two levels. Especially in technology company, it is so true. First one, whether they are able to hit 100 million turnover or revenue. Next phase, whether they can hit billion turnover. Now, once you either go to the venture capitalist or through the IPO, you have your basic funding and start getting your product and building the infrastructure, decide what kind of business model you want to be and how to grow the subscription and then monetization model, everything, right? Now, they say, according to this study, they say that the revenue growth year by year should be 60%. Yes, you are right. It sounds crazy, but it is true. If the 60% revenue growth is not achieved, the chances of staying in the field itself is very low. Because there is a simple theory. Grow fast or die slow. They don't have other choice. Imagine in any other sector, if you have 20-25% of revenue growth, investor like me is very happy. But the same logic doesn't hold true. In technology companies, the major factor which decides their survival and success is revenue growth. The growth potential alone. So, It's only around 28% of the companies could achieve that 100 million turnover. Means year by year growth they could reach 60% they could get, and then they could get the break even, then they made it the positive revenue, then they again grew it at 60%, finally they could hit at 100 million turnover. The next stage, hitting 1 billion. Surprisingly, it's only 3% of that companies could reach up to 1 billion. We know now the giants like Google, Microsoft, right? Why it's very difficult? Again, the major driver here is growth in revenue. It has to come from expansion strategies. It may be product expansion or geographical expansion. The companies should figure it out and then have a smooth transition. What do you mean by smooth transition? Means they should know what is the right time to have the transition. They should have a right product, stand in the right time, and have a right target addressable market. For example, say now the internet penetration, internet adoption, usage, how much it is increasing. I think just in 2 years we have moved from 2 billion to 4.95 billion, right, globally. And look at another parameter, that is growth in digital spend. It is also growing in an exponential manner, crazy way. So now connect the internet penetration and the digital spend. Google is right there. It is all ready, with its revenue, with its good business model to encash this opportunity and to reap its own profit share, right? So if a player makes a smooth transition, identifies his correct target, and then again starts his expansion strategy, again gets more than 60% of the revenue growth, then he hits billion turnover. If you hit 1 billion turnover, then you are the rarest of rare and very less chances of coming down from that point. It's always like, big players, giant players always win, and everything falls in their favor from that level. This is how grow fast or die slow strategy wins here. Why I am saying this? Let me again connect the same thing to my basic point. Look at NASDAQ. The major weightage is from the acronym which they use is FANG, which is Facebook, Amazon, Apple, Netflix, Google. It's very true that in this time, post-pandemic, we have expected too much from them. Actually, the PE has gone to a crazy level and the bubble has burst. So probably what they were worth for just 3 months or 6 months back, they are not valued at same way, right? It's okay, but they are the real business models. If you think, the major weightage of the NASDAQ is from FANG and they are in that rare 3% category. They have made it too big to fail, and the next growth in technology will come from them. If you believe in the way technology has become the consumption and the way in which it can revolutionize each and every aspect of our life going forward in the future. They say that there are going to be only 2 types of companies in the future. What are they? Technology and technology enabled. So I truly believe in this. I feel digitization technology is here to stay. This is, if you think about the blockchain and the AI, everything, this is going to revolutionize, and these are the disruptive technologies. This will stay because I feel this is a fantastic opportunity which we are getting to build our generational wealth. This is actually a perspective pill. It's not a suggestion, because in case of investment, you have to decide what is your risk tolerance, what is your financial goal. You need to do your homework by yourself. But I really wanted to give a thought exercise to you so that if you find it relevant, it will really be very helpful. So do your own due diligence. If you feel that You are agreeing with me? Start building your portfolio now and build your generational wealth and cash in this opportunity. Thanks for watching video. See you next time.